Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the Market Site studio for Financial Literacy Month, which of course is every April, we have Caleb Silver, Editor-in-Chief at Investopedia. Caleb, it's great to see you as always, and let's start with the basics. Investing 101, and the one thing you need to know is the magic of compounding, which is why you start early.
Yeah, that's right, and that's that fairy dust, that magic fairy dust that's sprinkled all over the stock market if you give it time. Compounding is an asset sort of earning money on its money, and the interest you earn earns money the next year. And if you keep adding and you earn interest on that money, it compounds over and over again. And that is how you go from small fortune to big fortune. But it takes time, so you got to reinvest those profits. You got to keep investing and take advantage of that fairy dust.
What about the Rule of 72?
Yeah, the Rule of 72 is a famous rule in investing that really calculates the time it takes for your money to double in value if you invest it and if you invest those dividends. So you have to have a reasonable place to start, which is a 6 to 7% return. The stock market returns about 8 to 9% a year on average, but 6 to 7% if you're a little bit more diversified. And that Rule of 72 shows you how long it would take your money to double. But the whole thing is to stay invested and take advantage of the compounding. Compounding the Rule of 72, they are cousins.
There's a lot out there. What to buy?
Yeah, you could buy a lot of things as an investor, but if you're a young investor, for example, you want to be buying stocks. You want to be buying these longer-term growth assets and investing for the long term. It's a marathon, as you know. It's not trading, it's investing for the long term. So there's mutual funds and index funds. Mutual funds are big baskets of stocks managed by a professional money manager or portfolio manager. Index funds just track indexes like the S&P 500, like the Nasdaq, where we are right now. You could just buy those and ride with it. You can buy ETFs, which are baskets of stocks that trade like a stock, but they're really diversified baskets of stocks. So instead of just buying one company to bet on a sector, you buy a bunch of companies, and they're much cheaper than index funds and mutual funds. You could buy bonds, you could buy alternative assets too. There's all kinds of different assets, but you have to think about what your strategy is and what your long-term goals are. But a good place to start for new investors is the stock market.
How often do we buy?
As often as you can. At Investopedia, we say the best day to start investing was yesterday. Next best day is today. You've got to keep buying over time and dollar cost averaging, and that means buying no matter what the market is doing, as long as you have a long-term plan and you're managing your risk.
How important is diversification?
Huge. Diversification is everything. You don't want all your eggs in one basket. You've heard your grandmother say that to you in the past. Other people have said it to you in the past. You've got to be diversified, because in markets, we get all kinds of different cycles. We get weird things that come out of nowhere. You want to make sure your portfolio is protected, but also positioned for growth over the long term. Diversification, a diverse bunch of assets, and diversity within the stock market itself, very important for that.
All right, Caleb, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me for Financial Literacy Month. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.